Happy Friday, everybody, and welcome to What the FICC, the spot for fixed income, commodities, and currencies. Spencer Israel is away today, but have no fear. I've got the Director of Research from All Stars Charts, Steve Straza, joining me today. Steve, what's happening?
Hey, man. How's it going?
Good, man. Good. A lot of action today. Lot of movement. We got to talk about the dollar, right?
Yeah, I'm excited to be here. I haven't done the show with you or any shows with you in a long time.
You know what's funny? I was thinking back, like the last time we shot What the FICC together is when it first started.
That's
I
right.
think you ran the first few episodes of What the
Right.
FICC, almost a year ago.
Spencer gets to have all the fun now.
I know.
So the biggest thing that stands out to me about this deck as I'm flipping through it,
Mhm.
we're missing a big candle here. A really big candle. Today's price action in the dollar, my goodness.
I know.
Ian, we haven't seen a day like this. So in terms of just the single day performance in the dollar index, Dixie. Let me double check my math here, but this is the worst day for the dollar going all the way back to January.
January.
We've seen it
So
before, right? Remember like the highs from last year when we peaked and rolled over? You see that rate of change kind of spike around.
mhm.
So maybe getting it again on this little coil resolution.
you know, would would you consider today's action a bearish momentum thrust?
Yeah. Yes. Totally.
Definitely a downside thrust today. But here's a zoomed in look over the past year. Even with that downside thrust, they have to see where the 14-day RSI is what the reading is at the moment. I don't have that offhand, but it's looking like it's breaking below that 105.60 level, 105.50, 105 level. Still in a bullish momentum regime so far.
I
And
mean,
we haven't closed yet today.
yeah, we're still far from oversold, Ian, right? Like we're just breaking like 40 here, but it's the lowest momentum reading since July, right? So it
Yeah.
does.
Yeah. And I'm apprehensive to go ahead and call it and say that, this is it for the dollar. This is it for rates. Everything's turning around. Because going back through the charts, and it just today's action just felt eerily similar to what we experienced last fall. We had a similar bullish consolidation above a critical breakout level. We got that failed break or a breakdown. That bullish continuation pattern failed,
Yep.
found support, and then ripped higher.
Like this. I see what you did
Ripped higher. And then speaking of thrust, speaking of momentum thrust, I look at this chart of the consecutive weeks up for the
Yeah.
US dollar index. And seeing a pullback right now makes sense. The 105 level is still really important. But could this just be a little downside flush and then second leg higher for the dollar?
This is good context. I like what you're doing here, right? A little devil's advocate is important.
Yeah.
It's important to remember, yeah, we did just have a consecutive up week thrust. The price action is eerily similar to fall of 2021. We got that breakout and then a hard retest after a coil and then a recovery. What I will say is from a risk asset intermarket standpoint, we're also thrusting in things like small caps, micros, growth stocks, Bitcoin earlier, right? So there's that intermarket confirmation where the risk assets are buying a breakdown or the price action there is supportive of a breakdown or a dollar index below 105.
Absolutely. I hear that. In getting to small caps, like that you just mentioned, small caps. What's interesting is we're finally starting to see an upside resolution in small cap value versus small cap growth. I'm waiting to see this thing get back above last year's October pivot lows to follow rates higher. So is there a catch up here? Is this intermarket ratio telling us that rates are going to remain higher for longer?
Right, because okay, so this is the IWN, IWO, Russell 2000 value versus Russell 2000 growth ratio.
Mhm.
And what we tend to see, like you're saying, is this ratio moves higher, value outperforms growth when rates are rising. We just hit our highest level since March in this ratio. If you look at the price action and interest rates this week, huge divergence over
Right.
the very near term, right? So who's right here? Who's wrong? For now, listen, rates rolling over is just another one that you kind of throw in that basket of intermarket support for a dollar rollover, because that relationship has been really strong too, stronger than yeah. This is
Yeah.
the one I like, and I
Mhm.
think it's the one that we need to focus on. And when I think about the bond market right now, specifically U.S. Treasuries, I think these Treasury issuances are having a huge impact. Like, we always have to pay attention to new data, and this isn't something I've paid attention to in the past, but people have been talking about it this year, and it's been spot on, right? So I think it's just a matter of supply and demand in the Treasury market. As those issuances dry up and there's less supply coming to the market at these auctions, then that's going to put downward pressure on rates and maybe finally allow bond prices to rise, and that's what we're seeing this week. So you have like double tailwinds for risk assets this week, right? Shown in this chart.
Mhm. Absolutely. I mean, when you look at a long-term chart, I mean, this is, monthly candles, fresh monthly candlestick for a couple days old, but you look at this structural downtrend in treasuries, and to see the Treasury Department, tighten supply makes sense, right? It makes sense. And we're at levels. We're at critical levels, whether we're looking at, TLT, this critical shelf of former lows. I mean, these are all-time lows for TLT.
All
This
time
this
low,
this E this ETF's only 20 years old or so.
and we're thrusting off them
Mhm.
this week, right? So bonds really rallying higher with stocks this week. Speculative growth stocks too. We know how strong that relationship is. So you're getting thrusts here too. If you pull up something like TLT, maybe I'm cherry picking a period here, but on a 3-day rate of change basis, Ian, oh my goodness, you'd have to go back to COVID. So it's been, 3 consecutive monster days for treasuries. This is the kind of momentum you tend to see at turning points.
Yeah. This TLT chart, I have a 4-week rate of change in the lower pane, and highlighting when you get a really, really strong peak over that longer time frame, at least over the past decade or so, we're reaching the levels that we saw last year or earlier this year, and spring of 2020, and even back in 2011. Those tend to coincide with near-term tops.
Yep.
So we'll see. Nothing like that yet. Nothing like that yet to point to, but something to keep an eye on, in the coming weeks. It's also interesting to look around and just see, 25 zero coupon, 20 plus 5-year plus zero coupon ETF, ZEROS, also bouncing higher, ripping higher off of a shelf of former lows. It's the same story for IEF, same
Yep.
story for IEI.
So logical levels,
These are
right?
logical levels. These are logical levels. IEI is actually reclaiming a key pivot low here, right above 113. But at the same time, when we zoom in on the actual Treasury futures, still in a bearish momentum regime. There's still a lot of work to be done. This is TLT, still in a bearish momentum regime. Let's see the 30-year T-bond futures, looking to break to the highest 14-day RSI reading since May. I think that would be extremely constructive for bond bulls.
Sweet momentum divergences here.
Yes.
And getting some
Yes.
information today, like if you had today's data in here, like where you have that red dotted line drawn, we're tearing right through it.
Right. Yeah. Christian Tharp was on the show earlier this week. He was on the morning show earlier this week, highlighting these bullish divergences and looking for a near term upside reaction. And he was very clear that it was short term tactical trade. We're seeing it now. Is this something that buyers can build on and continue to drive prices higher into next year?
Is the trade is okay? Let's make a big assumption here, right? Rates are done rising. Okay. Is the trade go buy treasuries, right? Or can rates stop rising, but maybe bonds still aren't a great investment? Maybe they're just kind of stuck rates, right? You don't get that descent too quickly, like people maybe are expecting, and you're better off maybe in something like stocks, where maybe they do experience a nice tailwind just with rates stopping to, rise the way they have been.
I think it's the latter. I think it's the latter, and you can tack on precious metals. You can tack on gold and silver. AGI breaking out today above that 13 level we've been highlighting lately. I look at treasuries, I look at TLT, and for me personally, again, this is just who I am as a trader, as an investor. I need to see more. I need to see more of a base building process before I really want to get behind a rally in bonds. But it's undeniable. It's undeniable that they're ripping higher. The breaking out of these bearish momentum regimes, and this could be it. This could be it for rates. But I'm not too sold yet. I think if we do want to buy bonds,
okay, good. I was
why
hoping
not? Why not? Why not go with the high yield bonds?
Well, wait a second. Hold on, sir. I mentioned to you yesterday because I was on my walk and I was thinking about high yield bonds. That's what I do on my walks.
Yeah.
And I pinged Ian and I said, Ian, thoughts on high yield? You tried to skirt the question, start talking about spreads. And then you just weren't that excited. But isn't that the trade? If this is all these things we're saying, if this is dollar rolling over, rates rolling over, stocks catching a bid, risk on into year end, isn't it high yield?
If you have to own bonds.
Okay.
I think it is. If you have to own bonds, or to answer your question, we could just own stocks. And I'm not saying the S&P 500. I'm not saying go out and buy the index, but I think we can look to equity plays and get our risk exposure that way instead of the high yield bonds.
I would agree, right? There's probably going to be more beta there, and I think maybe high yield bonds is still a little cute. I don't know if you need to take that risk. But clean level here in Angel, and I do like this fund, right? This is Fallen Angel, so bonds that just had their credit rating slashed or something, if I understand this correct.
Yep.
And then where is commitment of traders data these days for treasuries? I haven't looked in a while.
That's a really good question. I haven't either. It's been so stretched.
Right.
And that it grabs my attention when it reaches these extreme levels. But I need to see more action in price. Let's just look at the 10-year yield, or 10-year T-notes here. I need to see more action in price, some sort of reversal again in price before, and an unwind in positioning. So before I really take any kind of serious note. We haven't seen it yet. We haven't seen any extreme unwind in positioning yet.
Yeah, I like
of course, Bill Ackman came out and tooted his own horn last week and claimed that he closed all of his bond shorts. But I mean, we'll see. We'll see.
What is with these guys? And then Bill Gross was on yesterday or the day before on one of the networks, and he was calling the bottom in regional banks. Sir, you're a bond trader. leave the stocks to the, whatever.
Yeah.
You want to talk about copper or gold or crude oil, some of these commodities? Because
Yeah,
it goes with thinking that a weaker dollar would be good for these assets. But Ian, hasn't the relationship kind of been flipped this year? Things
it
like
has been flipped, and a lot of that has to do with this chart here, which is that strong relationship between the dollar and rates. Commodities are at least the pro-cyclical commodities are more sensitive
rate.
to rates. Exactly. So that's really been the driver.
So wait, so let's just summarize this for everybody because I think it's such an important point, an intermarket principle. We
Mhm.
talk about these two major intermarket headwinds or tailwinds all the time, rates and the dollar, right?
Mhm.
We talk about how if they stop rising, that's usually a really good thing for risk assets. What we're
Mhm.
usually talking about is stocks. For the stock market, would you say dollar is more important? So a weaker dollar, definitely major tailwind for stocks, higher stock prices, lower dollars, right? But then when you talk about commodities, so also risk assets, different risk assets, commodities, sure, dollars matter a lot, but you're saying maybe rates matter even more. So lower interest rates would actually mean lower commodities, higher interest rates, higher commodities. Is that what you're
For
saying?
some of for some commodities, absolutely. I mean, if you zoom out, I didn't bring a chart this afternoon, but if you zoom out and overlay the dollar with the CRB index,
Yeah,
the negative correlation's strong,
sure.
and it broke down a couple years ago,
Mhm.
right? I think that the dollar is important, but when it just depends on what area of the commodity space we're talking about.
So what
And
are the pro cyclicals then that you are
the
talking
pro cyclicals, mainly when we're looking at the CRB index, it's going to be crude oil. Now, how well has crude oil and energy performed over the past 3 months as
about?
the dollar and rates have risen? Pretty well. Pretty well.
Uh,
So,
Crude did well since the summer lows, but it's tapered off a little bit here.
right, it's tapering off as the dollar and rates start to roll over. And that's really that's the point I want to make. Crude, back below this 83 and a quarter level. I think it's messy to lower right now for crude oil, and it's actually dropping today. So just looking at crude oil, just looking at the numbers today, crude oil is falling, and in base and industrial metals, mainly gold, silver, and copper, are catching a bid.
You know, it's crazy. I just overlaid crude and the dollar. It's crazy how tight these things have been
Yeah,
all year.
yeah,
Wild.
yeah. It's interesting, isn't it?
Yep. And you're saying seeing it, even right here over the super short term today, both lower again.
Yep, absolutely.
And crude kind
So
of, if you're really like drilling into that relationship, which I don't think is the right thing to do, but if we were for fun, crude did make a new pivot low just earlier this week. Right now, dollar following.
yes, and I gotta imagine that crude continues to fall if dollar rates, if this is it and dollar rates can, are dropping.
Okay, I like that point, and that's why you were trying to, I think, make very clear when we were talking this morning. It's tech stocks then in that environment. It's not energy stocks. It's not commodity stocks. It's growth stocks.
I look at it more, not so much, I think I look at it more as energy versus tech. That's really the big relationship that I like to monitor. And yes, I think tech is going to outperform with the
And it's
dollar below 105.
and then let's elaborate. Not even just tech. You're talking about long duration, high valuation, growthy stuff, right? The
Yes.
speculative stuff. And we are seeing it right now, like in a monster way. Like we're seeing, like we were talking about before. You're saying, let's be careful now. Let's make sure we get confirmation from price in our own markets. And I'm
Hmm.
kind of saying, but hey, when we look at the inner market, other assets are kind of jumping this move and confirming it. ARC's 5-day rate of change, highest level since June of last year. I mean, these stocks are absolutely ripping. ARC's up 6% today. So that's that speculative growth trade saying, hell yeah, lower rates. We love it. And you get a momentum thrust. So thrusting.
And I love that. But then, again, like I have, maybe it's just a scar tissue. Maybe it's just really fresh for me. Maybe last year's still just, still feeling it.
I think it's the
Remember
right.
those rip roaring rallies, historic bear market rallies last year, where the market was thinking, hey, they're done. They're not going to hike anymore. Here we go.
And
It's been messy for longer. And so I don't want to get ahead. I don't want to get ahead of myself here, or get ahead of rates.
I think that's the prudent kind of
Yeah.
way to approach this. Like, listen, I got super bulled up like a month ago. We had that
Yeah.
monster engulfing candle like October 6th. And we had a little couple days of follow through off the lows and then just got slammed again. But
Right.
just like if you just look at the last two candles in Russell 2000, ARC, whatever. I mean, stocks are really making a statement the past 2 days.
I remember that when you were getting real bulled up, and I remember it coming through over Slack. And I was just thinking, oh man,
Listen,
okay. But then you immediately qualified your, hey, like I'm really bullish, these tech stocks right now. And you're like, until next Friday.
yeah, and
And I was like, yeah, that makes sense.
yeah, it was a good trade.
Yeah.
Slammed hard, and then we went back, and now look, today S&P is back to like those pivot highs from middle of October already here. We were talking about new lows, Ian, a week ago.
Yes.
Talking about S&P lowest level since May. Oh my God, right? Russell 2000 new multi-year lows.
Yep.
Now you look at something like the NASDAQ 100, not far from new highs. So.
No. Yeah, it's been an amazing week. It's been an amazing session today alone.
Fed out of the way now too, right? That's important. Fed's out of the way for a while, if I understand. I think we have like a skipped month.
They don't there's nothing next month.
I
It's
don't
not
know.
December.
I think we got like 40 days until the next Fed.
40 days. Oh boy. Oh, so it's mid-month. That's good. I I look at the copper chart and seeing copper back above that 363 level. Talked about this last week in the commodity note. This is just constructive for not just commodities, but just risk assets in general.
Ian, if rates are done rising, does that negate a commodity super cycle thesis? Or could they just kind of like remain elevated and we still get commodity super cycle, or they need to keep rising?
That's a great question. I guess it's probably has more to do with, well, I guess when we talk about rates, you're talking about inflation. They kind of go hand in hand. I think if rates remain elevated, inflationary pressures, pick up again next year. I mean, that would make sense within a commodity super cycle.
Because inflation expectations coming off in a big way here this week also.
They are coming off in a big way. And I thought that was really interesting. I sent you a chart. Here we go. Looking at these, the tips, high yield,
that's what's
investment
driving
grade, and treasuries here. It's interesting to see that high yield, investment grade, and treasuries all held those pivot lows from earlier this year. But
great chart.
Tips dropping, undercutting those pivot lows.
Right. So when we talk about the weakness in that inflation expectations, I'm looking at the tip IEF ratio.
Yes.
That's exactly what you're saying. Tips breaking the new lows. You're seeing that weakness in the ratio while treasuries are holding. Interesting.
Mm-hmm.
Okay.
Yeah. And
right,
we were pointing out a couple weeks ago the big divergence between break evens and tip IEF. Maybe there was something in that, I mean, I
think so.
It's hard to tell in the moment, but yeah, very interesting.
So going forward, I think one more day of follow through. on this Dixie weakness here today is really all you need. We're back in that box, at least for now. Sideways at best, more of a mess, right? More ranginess from the dollar, not necessarily down.
Yeah, and I think that's enough, at least for risk assets, at least for equities. I think, you know, rangy, messy rates, dollar would be amazing.
Dollar just back in that box, no matter where in that box, if you throw up a Dixie chart, I think that's enough for like a Santa Claus rally, and then we'll talk about next year.
Right, exactly. Exactly. And you know, and if it's back in that box, what was it? It's November 3rd. I mean, this could turn out to be an excellent month for stocks, and that would fit. That
Well,
would
great
fit
point.
the seasonality.
Traditionally, November, best month of the year. Also, did you know week 44, best week of the year?
Week 44?
Print it.
Week 44. I'm writing that down.
Mark your calendars. That is the week for stocks. Data back to like 1950. Oh,
is that in your Trader's Almanac?
We ran the numbers ourselves because I had to check for myself because JC was like, it's the best week of the year. I'm like, no, it's not. So I went and checked. He was right.
Love it. Man, so in terms of are there any individual equities that are on your radar?
Listen,
that you really like here or early next week?
For now, like this week's action has been incredibly broad-based in such a bullish way. Like we're having like a 95% up day on the NASDAQ 100 today. Everybody's like, oh, Apple's earnings are so important. Apple. Guess what? Didn't matter. The rest of the market's ripping just fine. Yesterday we had like close to a 90% update for the broader market, right? So very thrusty. The hardest question for trading on the long side is always, do we buy the best stocks? Do we buy the leaders? Buy the stocks breaking out, buy the new highs? Or do we buy the most beaten down, messiest stocks coming off of lows, right? And bet on some sort of dead cat bounce. And I think to answer that question appropriately, you have to ask a question back and say, well, who are you, right? What are your goals? What are your objectives? What are your risk preferences? Because some people might want to just rip off those lows, trade Carvana, trade like a heavily shorted name, 3, 4, 5 days of gains, boom, you're out. You're going to make a lot more money that way than you would buying Apple or Microsoft or NVIDIA, one of the leaders. It's a higher risk, higher reward trade. Right. Not always going to work. When it does work, it's going to work great. Leaders, more conservative, right? You're probably not going to have as much juice. You're not going to get those dead cat bounces or massive counter trend moves. But both should work in an environment where this is a new correction low. There should be plenty of longs that work into year end. So I would say if you want the conservative leadership stuff, right, it's big cap tech and it's big cap growth. All the usual names, right? Just go back to the well. They've been working. They'll keep working. If you want that juice, you want that beta, you want to take on a little bit more risk in the year end, look at the more speculative stuff. Look at the ARKY stuff. Look at the small caps. Look at the micro caps, right? Those are the laggards. Those would be the catch-up trades. So something for everybody, I think.
Well said, sir. Well said. I think that'll wrap us up. I think we've gone over 30 minutes. Man, that flew.
You should have this guy on again. This was fun.
Yeah, man. I would love to have you back. I'm sure Spencer will be taking off again here soon. Maybe just sit in for him.
Thanks for joining us, everybody. Have a great weekend.
See you guys. Thanks for watching.
Bye.